So hello everyone, my name is Oge and I'm back again. So today is the explanation. I'm going to explain to you the internal liquidity and external liquidity. It's something that you know, but I want to explain it in a way that will make your trading very easy and very smooth for you to go through. Now, the internal liquidity is your fair value gap, your order block, and your liquidity void. While the external liquidity is your old highs and old lows, and external, that's your equal highs and equal low, in the sense that there's a rule guiding it. When market takes an external liquidity, it must come back for internal liquidity, vice versa. Now, what does this mean? My coach did a wonderful job. I always say my coach because he's an amazing man. He took his time to explain this for me, so I have to appreciate him for being a nice coach, which I'm giving to you guys on an amazing value also. So when I mean vice versa means that if market takes out internal liquidity, market is coming back to take external liquidity. And if market takes external liquidity, market is coming back to come and take internal liquidity. It's like a game, in the sense that I'm going to use EUR/USD to show you how it works. Now, let me go to a higher time frame of 1 day. This is a 1 day chart. Am I correct? Yes, I'm correct. Now, if you look at it very well, right? We all know that internal liquidity. Okay, this is a forwarded chart already. I'm trying to find something very nice to explain this very well for you. Okay, we'll stick on 4 hours. Now, on the 4 hours chart, these are the rules, right? Do not forget the rules: internal liquidity, external liquidity. Am I correct? Yes, I'm correct. So we have here internal liquidity. If you go to the past here, we have internal liquidity. One, we have what? We have order block. You can see market reacted there. We have what again? We have the fair value gap. This is a liquidity void, and we have what? Liquidity void. But if you can see on this direction here, there was a shift in market structure here. That is the swing high. You can see that, right? That is swing high here. There was a shift in market structure here. There was a break of structure. Now, if you see this, a break of structure here, you can look at this very well, right? If you look inside, there is a swing high, meaning there was a shift in market structure because it's an internal structure, either on 1 minute or so. Now, if you look very well now, these are what? An internal liquidity order block. Can you see that? Order block, that's the first one. There is no fair value gap, there is no liquidity void. Now, if you go to the past now, there must always be something that would make the market come back. Something that would make the market come back for it. Example, there is a break of structure here. Internal liquidity. We have what? A swing low, order block. Am I correct? That's the first one. The second one for internal liquidity is what? The second one we have here. Let me drag it for you. These are internal liquidity section here. Now, the second rule that we have here is what? Fair value gap. Internal liquidity. This is what? This is a fair value gap here. You look in inside here, look in very well. This is a what? This is a fair value gap. You can see that. And it came what? It came back and what? It took out the external liquidity. Do you see that? There is no liquidity void. So every time market comes in and take internal liquidity, market is coming back to take external liquidity. That is what? Our old highs and old lows. Sometimes also you can also use the equal highs. This is the equal high and equal lows. You can see this are liquidity. You can see this, right? Okay, now market did what? Market did a shift in market structure. But market has shifted structure here. I'll put a zone here around here since market have shifted structure. But I want to just give you example directly on what I'm talking about. Equal highs, and equal lows. Now you can see it here. Around here, market created what? You can see it here. from the high to the, you can see it here. Market came what, took it out, and what, went down. You can see it here. That's external liquidity. And when it goes for the external liquidity, it comes back and take internal liquidity. So if you can follow those rules, does not mean you will not follow structural demand. You can see here there was what, there was a shift in market structure, the swing low. I've done a video on swing low and swing high to help you a lot. Then the next thing is what, we're looking for liquidity void. These are liquidity void, but I'll call this a fair value gap because not liquidity void, it doesn't really have so much impulse move. These are fair value gap. You can see it here, the fair value gap here. And what do we have here? We have our order block here. Now what the market do? Market came and what, took out external liquidity. That's what, old low. So if you can follow this rule on your analysis when you're analyzing your charts, external liquidity and internal liquidity, and the rule that states when market takes out external liquidity, may know that market is coming in for an internal liquidity, or when market takes an internal liquidity, know that market is going for an external liquidity. That's your old highs and old lows. I've done video to explain this one by one, and I hope it helps you to understand what internal liquidity means and external liquidity means. And I know that it can actually change your chart and how you analyze the market. Also, structure is key, and your higher time frame will also help you in your analysis. I hope this video makes some impact. Don't forget to subscribe. Thank you so much. Yay.